it's very hard to lift the market when you have trillion, $2 trillion, $3 trillion companies that are now starting to roll over. So I continue to be on the case, and I've been consistent. If there's one thing it's been consistent that you will see inflation stay around 3% and the economy is going to start to have trouble. And we are seeing the lag effect of monetary policy, which is 6 to 12 months lag, starting to take more and more a bite out of the markets. In addition, we'll talk about the dollar yen. The dollar yen is now in a precarious spot because of the yield curve control loosening that the Japanese central bank is doing. And there's lots of issues.
On Thursday, the U.S. dollar gained strength, buoyed by elevated U.S. Treasury yields. The inflation data from the U.S. signaled an uptick in the consumer price index, which escalated from a yearly rate of 3% to 3.2%. However, this figure marginally fell short of the market's projection of 3.3%. Additionally, another economic report unveiled an upsurge in initial jobless claims, reaching 240,000, surpassing market estimates of 230,000. The U.S. dollar index surged above 102.50, marking its highest daily closure in a month, although it remained below the resistance level of 102.80. Simultaneously, U.S. Treasury yields experienced a notable surge, with the 10-year yield reaching 4.1% and the 2-year yield at 4.84%. On Wall Street, stock market indices concluded the session with marginal gains, propelled by the anticipation that the Federal Reserve would refrain from further interest rate hikes. Gareth Soloway discusses various factors such as the CPI, PPI, dollar strength, and global indicators in this video. He also analyzes charts and highlights key zones that warrant close attention.
CPI data coming out. Now the CPI data, Consumer Price Index, came in slightly better than expected, ever so slightly. I want to jump over to this screen right here. Yesterday, the S&P 500 opened higher on that better than expected CPI data. It rallied up. This is the 10-minute chart. So each of these candles is 10 minutes long. We saw a beautiful move to the upside, but then look at what happened the rest of the day. The markets collapsed back down. When I see price action, when you see good news, and the markets initially react well and then roll over, that's actually a bearish sign. It means that even with good news, there's institutional sellers that are pounding down the market. All right, so that's important to recognize. That was bearish. I even posted on Twitter yesterday that is not a good sign. It's bearish to see gains, especially on a low volume-ish type afternoon, get wiped out with the market selling. Okay, so let's go back here. Let's talk about the PPI data. The PPI data came in this morning. That's Producer Price Index. And the Producer Price Index basically means it's on the producer side. All right, that's the inflation. So consumer, that's what you and I are paying at the store, the consumer, the CPI. The producer is what the people that are producing the goods are seeing with inflation. Well, guess what? The CPI today came out slightly hotter than expected. All right, month over month, 0.3% versus estimates at 0.2%. Year over year was also 1/10 hotter than expectations. What does this mean? Well, to break it down simply, it means that on the producer side, inflation is starting to uptick. And we can jump over here, folks. You can take a look at what this says over here. All right, you can see the headline here on MarketWatch. PPI shows sharpest rise since January in U.S. headline wholesale prices. All right, U.S. wholesale prices pick up in July, PPI shows. All right, now, just to explain what this is telling us, this is telling you exactly what I've been predicting now for the last 6+ months, that inflation is going to get sticky above 2%, right around 3%. That is your bogey level right now. So my guess is we're going to hover around 3% for the next 6 months, let's say, and that's going to make it very hard for the Federal Reserve to ultimately cut interest rates and print money. And why? You might say, well, who cares about that? The economy's strong. Well, sure, the economy right now is strong, but if inflation remains at 3% or greater, what happens when we do hit a recession? Whether it's in 3 months, 6 months, a year, 5 years, what happens if that inflation is higher? The Fed is going to be handcuffed. And that is going to put this economy in a tricky spot, especially the stock market, that valuations are absolutely insane. Speaking of which, I wanted to show you guys this chart. This is a chart of the NASDAQ composite. And the reason I'm bringing this up, and this might be a little hard to see, but we're going to try to show it here. So this is the chart of the NASDAQ and the .com, the run up, the pullback, and I showed this kind of a couple days ago. But look at that run up, look at the pullback, and look at the big bounce, almost back to the highs on the NASDAQ. Now, if we go back here, right? We slide this chart over here. It's very similar. Sharp run up, pull back, almost back to the highs. And then again, the idea here is that I think we're going to start rolling over and coming back in. And by the way, nothing goes in a straight line. So you shouldn't expect the markets to ultimately go straight down. I don't think we're going to go back to the October lows anytime soon. But I do think now you're going to stair step down, small bounce, down, small bounce, and eventually test that level. And you can already see it, right? We know Apple's earnings came out. They were a little bit on the disappointing side here. So if we bring up that daily chart on Apple, we can already see that we've broken some key support levels here. Here was a beautiful upsloping trend line. Look at the waterfall down. You've now started to consolidate here, which means you're likely going lower on Apple. So Apple, the biggest market cap company in the world, basically $3 trillion, has now broken its upward trend line, which by the way goes back to the January lows on Apple. So that is a big break.
Following U.S. inflation data on Thursday at 6:07, gold prices experienced a decline, undoing the earlier positive momentum witnessed during the initial 12 hours of the day. The headline Consumer Price Index for July registered at 3.2% year-over-year, slightly below the 3.3% consensus forecast. Despite this, it marked an increase from the previous month's 3% figure. Concurrently, the core CPI exhibited a minor weakening, settling at 4.7% year-over-year, in line with expectations after being at 4.8%. Additionally, U.S. Treasury yields saw an upward movement. A closer examination of Federal Reserve monetary policy expectations indicates that while the report had limited impact on short-term interest rate expectations, the broader outlook reveals a nuanced shift. The 3-plus-year horizon experienced the most significant increase in tightening expectations, implying a more hawkish stance from the central bank over a more extended period. For further confirmation, please refer to the accompanying video.
This chart on the yen, the dollar yen, we can clearly see that in October, the yen was up here, or the dollar yen was up here. All right, so huge move up. In October, the markets bottomed. It coincided with yields coming down and the dollar yen starting to come down. Well, now we've been same thing, starting to move up on the dollar yen. And what we can see here is that on a technical basis, we're now hitting resistance. But if this breaks, if this pivot high breaks through, you're likely going back to this level up here. So again, watch for that. Now we know again the Japanese central bank has said, hey, we got to loosen yields because inflation is now running rampant. The cost of rice or the price of rice is starting to skyrocket. That's a major impactor on their food side of inflation. And again, we're seeing that inflation bubble up. And I've said this before, but when you have 250% debt to GDP, you're not in good shape for having higher yields. Think about the amount of interest payments if interest rates really pop. It's bad enough the U.S. is now paying basically $1 trillion a year. We only have in the U.S. about 130% debt to GDP, which, by the way, I say only like it's acceptable. It's ridiculous, all right? Absolutely ridiculous to carry that type of debt to GDP, but that's what we have. All right, so that's something to watch here. Now, let's take a look at a couple of the charts here. So I wanted to go over, let's go over the gold chart real quick, because gold initially this morning was up, but what we're seeing is gold struggling again. So this is a little bit of consolidation. The big factor for me is this pivot low here, this trend line. That's the key trend line, which is right around 1880. I do think gold's going to turn up in a strong manner here, but part of the reason why gold has been struggling is because we are seeing the dollar continue to stay strong. Remember, the dollar is still the best currency on a bad block. Doesn't matter how much debt the U.S. has. Right now, de-dollarization isn't a big thing. It could be starting, but it's not an impactful factor when people get scared. They still run back to king dollar. And what we can see here is the dollar's up again today, just like yesterday, and that's making it very hard for gold to really rally unless there's major fear in the market. Now, you could say there is major fear. No, there's not. There's not. And the reason you know there's not major fear in the market is because if you go to the VIX, which is the fear index, okay, here's the VIX. Let's zoom out. Okay, and I have a trend line on this here from a while back, but let me remove that right now. But basically, if we look at the VIX, you can clearly see this is no fear down here. Then you had, by the way, this is COVID, the spike in fear. This is the 2018 stock market collapse in 6 weeks that took place here. And look at where we are. We're basically in no fear zone. And so again, while I'm enlightening you and kind of putting you ahead of the curve in terms of being ready for what could be coming and alerting you to a 3% longer term, inflation number where the interest rates are probably going to be higher for longer, like the Fed has said, there's still the average investor is oblivious. The average investor is buying the dip, and that's telling us this as well. You've seen a little uptick recently, not enough to get anything exciting.
U.S. wholesale inflation surged beyond expectations in July, reversing a year-long cooling trend. The Bureau of Labor Statistics reported that the Producer Price Index, tracking average price changes paid by businesses to suppliers, rose by 0.8% annually. This exceeded June's revised increase of 0.2% and consensus estimates of 0.7%. The rise in producer prices was driven primarily by increased demand for services, leading to a 0.3% monthly hike in definitive producer price hikes from June to July, the most substantial increase since January. Service prices also saw a 0.5% monthly climb, the highest since March 2022. Kurt Rankin, senior economist for PNC Financial Services, emphasized that consumer spending drives demand, causing producers to raise costs for materials and transportation, which ultimately affects consumers. These developments highlight the intricate connection between consumer spending, demand for services, and producer prices, reinforcing the Federal Reserve's vigilance toward potential inflationary pressures. Share your thoughts on Gareth Soloway's analysis in the comments section below. For more daily dose crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.